Good morning, ladies and gentlemen. My name's James Marley, co-founder at Livewire Markets, and we're delighted to have you joining us for our inaugural webinar, and we're going to get going in just a few minutes. So I thought I'd use this as an opportunity to make sure you check your audio settings and your volume and that your setup's all working. On the webcast page, you'll see there is the ability to access the slides, so if you want to download a copy of the slides, you can do that there. It's just sitting above the video player. And also, we'd really encourage you to take part in the discussion that I'm going to have today with Hugh Giddy from Investors Mutual. You can send questions in two ways. You can use the comments box, which is sitting at the bottom of the web page that you're on at the moment. Or alternatively, if you want to just send us an email, send your questions to team, T-E-A-M, at livewiremarkets.com, and we'll bring the questions through that way. So we're just getting set up, people are coming online. We'll be ready to go in just a few minutes, and sit tight, we'll be getting started very shortly. Thank you. Well, good morning, ladies and gentlemen. My name's James Marley, co-founder at Livewire Markets, and welcome to our first ever webinar. Delighted to have you online and delighted to have you with us this morning, Hugh Giddy.
Thanks, James.
Investors Mutual is an Australian boutique fund manager founded in 1998 by Anton Tagliaferro, which makes 2018 their 20-year anniversary. Quite an achievement. They have a conservative and disciplined style to investing, which I think is probably really timely to be talking about their approach to investing given how volatile markets are right now. We're delighted to be involved with their 20-year celebration and hosting this webinar, and I really think you're going to take some good insights away from the presentation that Hugh's helped put together today. IML is running a series of articles that really bring together the insights that they've collected over 20 years of investing. They're available on the Investors Mutual website, and we're going to dive into a couple of the lessons that Hugh's picked up and is able to share with us today. Hugh's the Senior Portfolio Manager and the Head of Investment Research, and joined IML in 2011, is that correct?
2010.
2010, alrighty. Right in the middle of the GFC.
Oh, actually after the GFC. The GFC happened in late 2008,
Yep.
and sort of really, the economy was weak in 2009, but the stock market turned in March of 2009 and had a rip-roaring rally. That's reinforced, I suppose, the mentality people have about investing, that every dip should be bought quickly, because they expect every fall to be a V-shaped bottom in the stock market.
It was still pretty turbulent times, I imagine, around 2010. Still a lot of nervousness in the shadows of the GFC, I would have thought.
Well, look, the companies are still raising money, strengthening up their balance sheets. Most of that happened in 2009, but it took a while for people to sort of feel that the recovery was solidified, I suppose. And if you look at some things like US housing, which fell from 2.5 million starts per annum to 600,000 starts per annum, a huge fall. The forecast by a lot of brokers was that that would be a rapid recovery back to what was then the long-term average of 1.5 million starts. The long-term average is now lower because we've been below 1.5 million for several years. But it actually took a long time for that to really pick up, and we're now at about 1.3 million. It looks like we might have even topped out at 1.3 million, which is below the long-term average.
Right.
So there was a lot of excess pre-GFC, and it takes a while to get through that to readjust.
Well, we're going to get into your stories in just a minute. If I can get the second slide up, please. Just run through a bit of an agenda about what we're going to talk about today. As we heard, we're going to hear a bit about Hugh's experience in investing in volatile markets and your early days there. And we've put together a few examples of companies where short-term noise or headlines have really created opportunities, and we've put together a couple of examples there. And then I think really getting into the core of your investment philosophy, you've put together a sector comparison on industrials versus resources. So we'll get into that there, and I think it really talks to the heart of the IML investment philosophy. As we've promoted, we really want to get people that are online sending through their questions. We want to make it interactive. Hugh's got plenty of time today to take your questions, and with the way markets are at the moment, I think it's a great time to put your questions to a professional fund manager. If you can just bring up the next slide. Again, there's the comments box at the bottom of the page there, and you just submit your questions there and they'll come through to me here. Alternatively, you can email your questions through to team@livewiremarkets.com. So that's the admin. The presentation will go for around 20-25 minutes, and then we've set aside plenty of time, as I mentioned, for questions. So why don't we get the next slide up? Sorry, just next slide, slide 5, please. The chart here, mapping the 20-year journey of IML, Hugh. Mm-hmm. Just talk us again through sort of some of the journey and why you've brought this slide along today.
If you look at markets, equity markets, but all financial asset markets tend to be a little bit correlated because it's human behavior, human instincts really based on greed and fear. People get confident, optimistic, and greedy, and they want to make money. They want to make money in property. They want to make money in shares. Everybody wants to make money easily, ideally. People don't prefer not to have to work for it. And so when they see other people making money, there's a sort of FOMO, fear of missing out. Oh, let me chase that. And so you get booms, and then people get overconfident, complacent, including business people. Business people often are investing more money into new plants or taking over other companies at market highs. When things are expensive, that's when people are often keenest to buy. And then you get a bust because there's an overinvestment, overconfidence, overbuild. I can give you an example. A good example, you have the bust. And a good example is, like you get to a market, say Sydney has been quite short of hotel rooms. And so what happens? You start building some hotels because you want to take advantage of the high rates available on a hotel room. But when you build more hotel rooms, of course, so the supply increases, the demand doesn't increase that much, the rates come down, and the valuations of hotel rooms also comes down. So the boom brings on the bust because the boom creates an environment where people feel confident to invest and create more supply that takes away the supernormal returns. So it's not just hotel rooms, it's lots of things. If oil price is high, people will do more exploration and drilling, and suddenly there's more oil available, and the oil price will over time come down because of that. So what we've seen over those 20 years is a series of booms and busts, and we're used to it as professional investors. That's what we expect. We know their cycles, and their cycles driven by that confidence and optimism followed by pessimism in the bust. And we've had the tech boom, and then we've had a resources boom. The tech boom and then the bust in sort of 2000, 2001 didn't affect Australia that badly because we didn't have that many tech stocks, but the NASDAQ went from 5,000 to under 1,000. And then you had a resources boom, commodities based off China. Then you had the GFC because you had a lot of credit in the US housing and too many fancy credit instruments. And then we had the GFC. where the credit markets froze up, and so too did the commodities markets. Oil was 150. Supposedly, this story gets invented often to justify the boom. So the story invented around oil was there was peak oil, i.e. peak supply of oil, and we weren't going to be able to keep up with demand because we weren't finding enough new oil, and the price went to 150. It was now, of course, it'd be laughable to say we're not finding enough new oil because the US has gone from being an importer to an exporter. It's one of the largest producers of oil in the world, all that sort of thing. But
So
at the
things that
time,
were-
it's convincing. And then we had the bust. The oil price went down below $30 from 150. That's
So-
markets.
So my question, while we're on this slide to you, is pockets of excess. They're easy to identify when we look retrospectively what they were. Do you get a sense that there's a lot of excess around at the moment?
Unfortunately, I do feel there's quite a lot of excess. If you look at the, in Australia, our housing market has been hot for so long. We've had an expansion for 27 years, and that's a very long expansion. People say it's a record. I don't know if the economic figures really back that up, but it's the longest expansion on record in theory. Where we haven't had a negative GDP for 2 successive quarters. And during that time, house prices have been very robust. In the old days, say in the 80s, house prices were 3 times income. Now, depends which series you look at, but they're saying like 8 times income. It's been facilitated by the drop in interest rates, so it's easier to service loans, but it's still pretty unaffordable. And if you look at house price per capita income, Australia's gone like boop, 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 and the rest of the OECD in aggregate, and obviously there's it's a mix and it's an average, has actually gone down. House prices relative to income have gone down in the OECD over 20, 30 years, and they're up in Australia hugely. We've got very expensive houses. That's a sign of excess. China's grown very fast, but it's done so with a lot of debt. Now, we've also got a lot of debt because the mortgage market. If you look in junk bond areas, junk debt accounts for a huge portion. About 60% of all corporate debt is junk debt. Junk debt, well, they call it high yield debt because it sounds better than junk debt. But high yield debt or junk debt is a very large portion of the market. But it's also, as the boom's been quite long, since the GFC, it's now quite a long expansion in the US and so on. Investors get more complacent and they haven't had a problem, and so they don't have a good memory in general. I specialize in looking at history and maybe too much and therefore get cautious too quickly. But the debt now, the high yield debt has very light covenants. So if you lend to somebody by buying that junk debt, your chances of getting your money back are worse and worse over time, and yet you're getting a lower interest rate than you used to, a lower spread over riskless debt or low risk debt, as in government debt. So there's excess around in different pockets. Sometimes no two booms are exactly the same, but they have the same characteristics where people get a bit overconfident, start speculating too much, buy stocks like Afterpay at $22, and next thing it's 12, and they're scratching their heads and say, how did I lose all that money? I shouldn't have taken that tip at the barbecue. But my mate said Afterpay is a good thing, and I looked at it, and it seems everyone's making money in Afterpay, and now, oh God, it's $12, and I've lost money, and I took out a margin loan, and how am I going to tell my husband or wife that I did this?
Okay, so Afterpay, I'm taking, is not on the buy list at IML.
No,
We move
not
to
yet.
the next slide, slide 6. Got a picture here from 2011. You alongside Anton. We know he's a passionate footballer and a passionate value investor. Tell me about, just briefly, give us a little bit about what is it that attracted you to IML? Why did you join? And what sort of core to your philosophy for investing there?
Well, what happened is I was in a boutique called Canna Capital Partners, which was started very unfortunately timing-wise in that we started investing money in October 2007, which was a high in the market. The market, ASX 200 was about 6,700, has never got back there. So although we raised money, the market went down, and of course the business's outlook was that it could take quite a while to reach profitability, and we were started and funded by Treasury Group, a listed company in Australia, and Treasury Group was also the major shareholder alongside Anton in Investors Mutual. And so Anton said to Treasury Group, I've met you before, I like your style of investing, how about putting the two companies together? And so Treasury Group facilitated that merger, and in 2010, myself and a couple of colleagues joined Investors Mutual. And as I say, I'd known Anton before. To be honest, he'd tried to hire me as his 2IC when I was at Perennial Value in the early 2000s, and I'd said I was going to stay put for the time, which wasn't a bad decision, I don't think. But so in 2010 we merged, but the reason the merger I think could work, because when you're merging a bit of ego and people who think they know everything, and I don't mean myself, I mean everyone else, of course, but is you've got to have a cultural fit where you believe the same things. You cannot put a growth investor with a value investor because they just see the world differently. And Anton and I both were focused on quality and value. And the people I brought with me who I'd mentored and taught basically how I thought to invest was really focused on quality. We want to own quality companies with good recurring earnings, good management, some growth prospects with a reasonable price. And there are growth investors who say, let's own these wonderful companies and we don't care so much about the price. And value investors, a lot of value investors really care about the price and not so much about the quality. And so we're not right in the middle, but we're on the value end, but we have that filter of we want a quality company.
Yeah. Well, we're going to get a bit into your investing style in just a few moments' time. If we can bring the next slide up, one of the things that we wanted to talk about was headlines and noise. But before we get into the headlines, we want to talk about trust and information that you can trust. And I asked you to bring along a few examples of information that the people who are watching the webinar can rely on when we have lots of headlines, lots of scary headlines going through. What are some of the sources of information that you think investors can turn to and trust?
Well, look, as a professional investor, I've got access to companies that most investors don't have.
So a bit of an unfair
we
advantage.
have a several billion under management, and that means that managements want to come and see us. And if we want to see them, they also make time for us and so forth. Whereas if you're an individual investor, that's harder. So it's good to be able to eyeball somebody, ask them the questions you want and so forth. You don't have to wait for the AGM and so forth. And you really do get quite a lot of access to management, see some operations, that sort of thing. And that's useful, as well as we spend a lot of time trying to talk to independent sources as well as management. So, but of course, just because you have access to them doesn't mean that they're always going to tell you the truth. Most people try and market themselves a bit or try and gild the lily. So I don't, although it's published and so on, I tend not to pay too much attention to newspapers. Occasionally I'm quoted in the newspaper and you can trust that, but generally, I'm not somebody who wants to extract too much from a newspaper, because the newspaper is reporting on what's past. It's not great at forecasting, and it's opinion as much as anything. And we see that with fake news and so on. So the thing that you really, I believe, in investing you can trust, it's good to have the access to management, is the accounts. And there's no way I ever buy a company without really going through the numbers. So it's a combination of trying to understand what the company does and the qualitative aspects, and does the company have a franchise, ability to price, good management seen by their actions and how they've deployed capital, good governance and good environmental policies. The ESG is actually very important. What's the balance sheet like, and so forth. But going through the accounts and looking for companies that try and present an overly favorable picture, and that and it's hard. You've got to be a little bit of a forensic accountant. I try and look at the cash flow, see is the cash flow matching the accounting earnings, because companies try and put things below the line, make out as though things that happen every year are non-recurring. Obviously they're recurring if they happen frequently.
Yeah.
And the cash flow shows you.
So from what you've told me, I'm taking investors out there, be a little bit cautious on the news headlines, take the time to get access to management via company briefings, AGMs where they can, so they can get that
Sure.
face-to-face, and focus on those direct sources coming straight out of the companies themselves.
Yes. But the trouble is also then you've got to overlay it with valuation. The companies with great franchises, very strong cash flow, often aren't that cheap. So, if you pay too much for a great company, even though it's a great company, you might not make so much money for a while. Maybe eventually the earnings catch up, but sometimes companies that are doing very well, like I mentioned, Afterpay's been growing very fast, but it was just the prospects of that company became too popular and, I believe, overvalued, but a reality's crept in.
Well, let's get into the investing side of it. If we can get the next slide up, we wanted to talk about where headlines, and we had a few headlines on the previous slide, have created opportunities for stocks, and create negative headlines, have forced stocks down. Regulation is one of those items. Talk us through that and how that has created an opportunity here.
Well, this is a stock I actually bought at Cannae in 2008. So pre the GFC, when the market was still pretty high, it was Ramsay Health Care, and it's the largest private hospital operator in Australia. And in 2008, we had the newly elected Labor government wanted to, I suppose, save some money. And one of the things was to change the private health insurance rebate. And they had a proposal, put it through Parliament, but the Senate, I think, rejected it at the time. But it made everyone worry that if they were going to get rid of or reduce the 30% rebate on private health insurance premiums, that people were going to stop having private health cover, and therefore, if they don't have private health cover, they're not going to go to private hospitals, which Ramsay is the main operator of, and that would be a problem for Ramsay. So the stock sold off 30% or so, and I thought, this is crazy. This is a very good company, very strong track record, excellent management. The balance sheet was quite good, backed by the property ownership of a lot of hospitals, and that over time people are getting older, they need more procedures. As medical technology evolves, there are more procedures available, and so forth. And I knew also that the government couldn't afford for too many people to leave private health cover, because the public hospital system is always bursting at the seams, waiting lists and so forth. They need the private health, private hospital sector and private health system to be okay, so that it seemed to me there wasn't ever going to really have that much of an impact. And what actually happened, as everyone knows, living in Australia, is that they did change the private health rebate, but you wouldn't see it on the chart. It happened in 2012, 4 years later, by which time Ramsay had gone up several fold. But that bad news, and it wasn't just the newspapers, the stockbrokers who analyse companies, they were also saying, oh, there's going to be a disaster for the private health insurance industry. That's why Ramsay sold off so much. Everyone got fearful and pessimistic on what had previously been seen as a good company. It was still a good company. But if you looked and analysed it and said, what are the probabilities that people are going to avoid private health cover? Well, there's the tax disincentive, you have to pay extra tax. There's the loading if you don't take it out when you're young. And the government needs the private health system. There are not enough public hospitals. So that all added up to, this is going to be a storm in a teacup, it will pass. And as it happens, it passed quite quickly. And then you had the GFC. You can't even see the GFC on that chart, because this is actually such a good business that was too cheap pre the real big falls in August, September, October, November of 2008. It hardly moved down because it was already down. And then after that, you made lots of money.
Rightio. Well, a more recent headline that really captured attentions was Brexit. It turned out, I think it caught a lot of people by surprise. If we can bring up the next slide. Clydesdale Bank, based over there in the UK, looks like it got thrown out with the baby. They threw out the baby with the bathwater.
Well, yeah, look, to be honest, Brexit's
it's still quite live today as well.
Yeah, it's a mixed thing for the UK. Some people think it's going to be great because they're going to save money that they would be spending on satellite European countries. The UK contributed more than it got back from Europe, but there's a free trading aspect to being in Europe and so forth. So there's pluses and minuses, and people have got strong views on whether they should or shouldn't be in. The vote was actually very narrow, but as soon as the vote happened, the pound fell a lot, and everyone started to worry about the UK financial system, because the UK doesn't, relative to the rest of Europe, UK is much more about services, particularly financial services like banking and insurance. London's the sort of financial capital of Europe, and Europe's more about manufacturing industries, cars and so forth, Volkswagen, BMW, Peugeot and so forth, as well as various other goods. And so people worried about financial services, and the thing about Clydesdale is they're almost like a building society, mostly mortgages, very well funded through a branch network, and it fell by a third in 2 weeks, and really it's, Clydesdale wasn't dependent, well, one, it's very well funded through its deposits, so it wasn't dependent on access to, say, French lenders or something for its funding. Like Australian banks have to go offshore for their funding. We lend more than we got in deposits by quite a margin. Effectively, because our house prices are so high, we've got to go and borrow overseas to lend people money for mortgages. They've got 90% deposit funding. So they don't have to look much for funding. They're mostly lending to households and small businesses in the north of England, not in the financial capital of London that's going to be maybe affected by global banks saying, well, London's no longer the financial capital of Europe, it will be Paris or Frankfurt, because Britain's not part of Europe anymore, it's part of itself, and there's the EU. So we thought this is a crazy overreaction just on Clydesdale, and you can see how then the market came to agree. It's been sold off again recently as Brexit sort of flared up, like they're struggling to come to an agreement on exact exit terms.
And so your thesis under that current environment holds true?
Well, yes. Look, it's got a lot of things going for it as a bank. We really like it, particularly compared to the Australian banks, unfortunately. And that is that the credit is very good. They, as I said, mostly sort of like a building society. They have a lot of mortgages where they lend up to 3 times income. If you lent in Australia only up to 3 times income, you wouldn't have that many loans, because our house prices are so much higher than 3 times income in general. They've got a merger that's been approved with Virgin Money, which will allow them a lot of synergies. Virgin Money is an online bank. They've got a branch network. They've got cheaper funding. Virgin Money, although it's an online bank, hasn't had very good transactional facility online, and so there's lots of synergies that almost everyone agrees will occur. And then they've got what's called advanced accreditation, where because of the low risk nature of their mortgage book and the low loss levels, they've only just received it. That frees up capital that they can apply to dividends, special dividends, or buying back shares. Especially now the share price has fallen a bit again with Brexit. That excess capital that's been freed up by the fact that their book is now seen as low risk will help them to support the share price if necessary with a buyback, possibly not right in the middle of the merger.
Yep. All right, well, a couple of stock stories there. If we move through to the next slide, this really gets into the sort of the process. IML focuses on industrial stocks. We've got a couple of slides here with a case study, so if we can move through these reasonably quickly,
sure.
If we can talk us through what we're looking at here.
Well, the first chart really just shows you, how the correlation between Rio, which is mostly an iron ore miner, they have other operations like diamonds and copper, but it's mostly iron ore, and of course that's the main input to their profits is what the iron ore price is. But they don't determine it. They can't say to their customers, okay, we're going to charge you $100 for iron ore. The market says iron ore $70, and that's what they get. Right. So it's a little bit beyond their control. All they can focus on is minimizing their costs, which, to be honest, they've done quite well at.
Okay. So bring up the next slide.
The next slide, that shows you how the earnings have been very volatile. They've gone up and down over the last 10 years, and that's because they don't control the iron ore price or the copper price. And it's a good resource company though. It's well managed. They've got good assets in the Pilbara and so on, but they don't actually control their revenues. That's determined by supply demand in China, and around the world, for steel and so forth. But increasingly, things like iron ore are determined also by financial speculation. There are a lot of futures contracts on iron ore and steel. Apparently, the average holding time for a iron ore or steel contract is less than 3 hours. So that's real long-term investors playing in those futures markets.
So on the flip side, if we move to the next slide,
And then
you've got the comparison with Amcor here.
And Amcor is just a classic industrial stock. It's it's now essentially an overseas exposure. Most of the operations are in the US, Europe, but in Asia Pacific as well, in South America. But chiefly US and Europe, a mix of rigid and flexible packaging. And packaging is used essentially for consumer goods, things like a bottle of Gatorade or a box to put, cans of beans or something, or packaging for shampoo, consumer goods. And so the demand for their products is very steady. They are able to increase the volume slightly and get some price over time, so that their revenue growth will be in the single digits, but it will be growth pretty much each year. Buffeted, of course, by currencies, but in a constant currency basis, that is steady growth with some amount of pricing power, because they are a global leader. Their customers need them, they need their customers, but it's not all over the place. It's not volatility, and you can see that in the EPS of Amcor that have increased pretty steadily. And because of that steady EPS, the dividend can increase quite steadily. So it's a much smoother ride. And Investors Mutual, we've always tried to focus more on providing a smoother ride to our investors. So we like to invest in what we think are more defensive, lower risk, lower downside risk companies, like Amcor. But there's several others, of course.
So if we bring up the next slide, what we can see here is a comparison of the share prices.
Yes. Now, look, this is a 10-year share price chart. Obviously, if we started 2 years ago, Rio looks better than Amcor. So it does depend a bit on the starting time. But over time, you can see that Rio has had a more volatile share price. Amcor's had a steadier share price. It's done quite well, although not as well recently. And more recently, Rio's done well because the iron ore price has been strong recently. But over time, obviously, you've made some good money out of Amcor because of that steadiness of growth and the steady yield.
Tell me, I imagine there's people that are watching the webinar that would own stocks like Rio and BHP. These are serious heavyweights in their industries. They're industry leaders. Why wouldn't you choose to own these at particular points in time?
Well, you would if you knew when to own them, because you make very good returns if you buy them when they're out of favour and when the commodity's out of favour and the commodity's about to go up. But there are two types of forecasters, I believe, if I can use this as saying, those who don't know and those who don't know they don't know. And most people, people are paid a lot to be commodity forecasters. I know I was talking to the chairman of Woodside, Michael Chaney, well, it's now Richard Goyder, but the former chairman of Woodside, and saying, how do you pick the oil price? Because you've got to invest long-term, build these LNG plants in Western Australia. How do you pick the oil price? He says, we've got this very good economist who's very eloquent, and he does a lot of work on supply and demand of oil, and he tells us the outlook for oil. And I said, and does he ever get it right? And he says, no, he's very eloquent, but no, his forecasting record's no good. And that's the truth. It's very hard to forecast. Like people pick recessions that don't happen. People think oil's going up and it doesn't. And so it's that's the problem. You're trying to pick something that's very hard to pick. Picking the direction of markets is hard. People will say, you sound bearish, and I do often sound bearish, but I don't know if the market's going to fall or rise. So all I believe that I can do is try and pick the best, good quality, reasonably valued stocks in the market. And if the market goes up, great. Hopefully they outperform. If the market goes down, I know that they will hold their value better. But I don't sort of say, I think the market's going down and therefore I'll pick these stocks. Or I think the market's going up and I'll pick these stocks, because most people can't pick the direction of any one thing. Yeah. But you can pick a good company with good earnings prospects, good underlying characteristics, good management, that sort of thing. That's what I can do more easily.
So if we bring up slide 14, which is essentially what you are looking to find as an investor.
Yeah, that's a sort of potted summary of what we look for. But to be honest, it's tough. It's not it sounds pato, just got to tick these boxes, but it's actually quite hard to find all those things together and not get overexcited about companies that have done well recently and extrapolate that into the future. Tend to think, a lot of people would be saying, oh, BHP's been good, because they look at the last, say, 2 years and see that it's gone from $15 or so to 33, 34. Don't you want to be a part of that? And they get pessimistic about saying that's fallen, even though it might be a better opportunity. Because a lot of investing is about emotions. And that's why markets happen. That's why in the initial slide I was saying that's how booms and busts happen, because people get overconfident and over-pessimistic. And it's very hard to be contrarian. Obviously, not everyone can be contrarian. Contrarian means being against the crowd. But it's hard to be against the crowd, and you shouldn't be against the crowd just for the sake of being against the crowd. You've got to have your reasons for it. Yeah. But you've got to go sometimes against the emotions of this feels good and say, actually, it's unlikely to be sustainable. I shouldn't just extrapolate the recent past.
Yeah. Well, listen, let's give you a couple of hard questions coming up first. So if we can just get the next slide up. For all those viewers, I hope that's given you a bit of an insight into how Hugh and the team at IML think about investing. Again, if you do want to ask some questions, use the comments box below. The slide shows you what that looks like. You just hit submit. That'll come through to us. Or you can send us an email through to team@Livewire Markets. We've got a couple of questions that have come through already, but I'm going to throw one at you straight off my own bat, because I think it fits into what we've been talking about, which is this concept of negative headlines in a sector where I can't think about. There is a long list of negative headlines facing the banks, and their share prices have fallen in that negative sentiment. For the banks, is it a case now, can there be any more bad headlines for them? Is that just a case where it's the share price will respond as each one of, the Royal Commission will pass us eventually, the housing market will settle down, credit will grow again? Is it peak bad headlines for the banks?
Oh, it's hard to say. It probably is peak bad headlines. I don't think the headlines necessarily will get worse, because a lot of bad stuff's come out about conflicts of interest. Part of the banks, there's two areas where they're getting hit. One is the vertical integration, where they have financial planning groups and so forth that are under the bank's ownership. And financial planning, there are a lot of very good planners out there, but there's conflicts sometimes where a financial planner has put clients into their head company's products, rather than a more objective, arm's length transaction where you say that in my client's best interest, I'm going to put that client into other products rather than my own bank's products. So that's the conflict of interest side. That's financial planning side. There could be remediation there because of those conflicts of interest. And the other thing is responsible lending, where the banks have lent to people very large amounts because the housing market's high and the banks justify the loan based on high valuation, but they've lent people based on low expenditure measures. They've used a thing called the HEM, the household expenditure measure, which basically suggests you're living almost on the bread line with your expenses and you don't have school fees, Foxtel, gym memberships, whatever else, plus the 3 coffees a day or whatever that people regard as necessities, not luxuries. And so that's, So anyway, there are a lot of headlines. Will they get worse? Probably not. But the implications of all that Royal Commission will be more regulation, tighter lending standards you're already seeing, divestiture of their financial planning arms. And so what actually happens to the earnings outlook is that there could be some pressure for some time. And then the other thing is the housing market seems to be coming off the boil. And of course, that's their main product. Over 60% of banks' lending books, which is their lending is their way of making money, aside from fees, is interest charged on loans. And the spread on the interest they hardly pay on deposits. When I say hardly, very low interest on deposits. And that, if the loan values fall, because if, say, house prices are lower, then they lend less money, and also if they want to be more tight on their credit, and say your expenditures are higher than we used to say, so we're only going to lend you this much, which is part of why housing's market's under a little bit of pressure, is the banks only want to lend X, whereas before they lent Y, which was bigger. That is going to restrict credit growth, and maybe that also will hurt their top line and their second order effects, as well as the remediation for
So it sounds like
breaking the law on responsible lending. They also have the top line under pressure. So it could be a while before you get good news on the banks.
Rightio.
Put it that way.
Okay. I've got a question from George. So you've conducted your fundamental research on a stock. Do you take into consideration the trend that the price is in, a downtrend or an uptrend, before you make the decision to invest?
Well, no, yes and no. Obviously, we'd look, obviously, what's been happening to the price, but one of the disciplines of being an investor is you shouldn't care that much about where the price has been or gone and the trend in the price, because a trend doesn't tell you where the trend is going. A trend doesn't last forever. Things don't go up forever, like Bitcoin went to 20,000 and now it's down. If you just said, I like the uptrend and bought it, you'd lose a lot of money. If you say, only by saying it's a downtrend, or when's the downtrend going to end? So really what you've got to do is just make your valuation, look at the fundamentals. If you think a lot of bad news is coming, it's hard to buy.
Yep.
You think it's in the price, but if you say, look, my assessment is that demand is falling for the widget you are selling, as a company, I'll wait until that announcement. But sometimes everyone else knows that, and so it's already in the price. So you've got to try and make a judgment on that.
So I'm going to give the short answer. It sounds like it is something that you do look at.
You look at, but it's not that important. The price, the level of the price is very important, but the trend of the price is not that important.
Okay. Next question. You talked about Ramsay before. Are you concerned about Ramsay's loss of Chris Rex?
He's been gone for a while. I don't. It's true to say that, we're not a big holder of Ramsay anymore, like we were, to be honest. Just as a caveat there. He appears to have left at the peak of a very strong earnings cycle, but does that mean that the business is really weak now? Fundamentally, it's still a strong business. They've got a very good private hospital footprint and so forth, but they have hit trouble in the UK, and France has been tough with tariffs, and maybe he foresaw that, but their earnings momentum's fallen quite dramatically since he left. He was a very good CEO, but that doesn't mean the new CEO is no good. I think he's good too, but the environment for him is a lot tougher, because it is an industry subject a bit to regulation, also a bit to demand, because private health cover is a cost. It's a bit of a discretionary cost. And in Australia, we're seeing a lot of people are a little bit under the pump financially. There are quite a lot of people under mortgage stress. They've got higher electricity bills. School fees seem to go up every year. There are a lot of things that are quite non-discretionary go up, and so that is causing people sometimes to say, can I afford something that's maybe a little bit more discretionary? And then you've had this scandal where some of the surgeons and so on have been charging out-of-pocket expenses that, it's not the problem of the hospital or the private health insurer. It's the surgeons who have taken free rein and say, or an anaesthetist, you have this operation, and by the way, while you're recovering, you get this bill in the mail and 5,000? What? Didn't know about that. That's caused a bit of disaffection amongst people.
So there's some other issues aside from the CEO.
Yes, I don't think it's all about the CEO.
Alrighty, this question, it's a pretty direct one, but we're live, so let's go with that. Question for IML, ARC Group. After the stock price fell, why did you buy shares off market as opposed to buying on market and supporting the share price there?
I'll be very honest here, and it's best to just say I have no ability to comment. ARC Group, the former Melbourne IT, is owned by a small cap team.
Yep.
I manage large caps, and it's too small for me to own, and therefore I don't involve myself in every decision, and I want to give a misleading answer.
Yep.
So apologies.
Alrighty, thanks for your question, Paul. Hugh, Howard Marks recently said that volatility to him is not real risk, but rather a symptom or product of risk. How do you define risk and how do you measure it?
Great question. I love that question because although IML is very proud of our low volatility, the thing I'm more proud of is our low drawdowns. To me, risk is risk of loss of money. And I think for most investors, it's about loss of money. Volatility just means, a bit more up and down. And we try and minimize that volatility because we think that's a more comfortable thing for investors. Volatility in and of itself is not a bad thing. It creates some opportunities for us to both sell or trim things when they get a little bit expensive and buy them when they get a bit cheaper. So it's a good thing. But the trouble is nowadays often high volatility is associated with down markets. So the two go together. High volatility and downside protection, kind of get interlinked. We focus, and I think risk is much more about trying to protect the downside, not lose money, because that's one of the easiest ways to make money. So not an easy way, but one of the key ways to make money is not lose money.
Yeah.
Obviously, if you don't go backwards, it's easier to go forward and compound over time.
Okay. Next question. This one's got a little bit of macro flavour to it, which I know is probably not your sweet spot, but I'm hoping you're going to have a view.
Yeah.
2018, the tax cuts in the US really seem to drive those markets over there. As a tailwind, does that tail off? And sort of what do you see as some of the bigger risks in 2019 if the US markets come off?
Well, the tax cuts helped company earnings. If you look at the S&P's earnings, you can't unfortunately trust them that much because they have these thing called operating earnings and reported earnings, and that's like the difference between looking at cash flow accounts rather than what the companies want you to see. And the operating earnings are quite a lot, so-called operating earnings are a lot higher than the reported earnings, suggesting low quality earnings. Companies have had tax cuts, and so you've seen quite a big rise in 2018 US earnings overall, but that won't be that easy to replicate next year, assuming the economy is still okay. And so maybe that takes away some of the support for a higher market next year. Risks in 2019, well, I think interest rates seem to be going up, bond yields are up. That's putting pressure on home buyers because the 30-year mortgage rate, 30-year federal government interest rate, bond rate, tends to be used as a basis for mortgage rates. And you've already seen the impact on new home buyers. And even maybe some people who've got a mortgage on their current home, but it was set when interest rates were really low, if they sell that home and then have to get a new mortgage, they'll be paying high interest rates. So they maybe don't want to move. So the housing market's quite weak. The housing market's often quite a key part of GDP growth. So I expect that my strong expectation, but as I said, there are two types of forecasters. My strong expectation only, it's not a certainty, is that growth will be slower next year because of these higher interest rates. Commodity prices, like the high oil price, but I don't know if that's going to be sustained, certainly hurt people in the hip pocket. People can see it costs more to fill up your car at the petrol pump, and that influences people. So I expect slower growth next year. But markets don't always follow growth. If you look at the Chinese market, it's made no progress while it's been one of the strongest growing economies. The correlation between growth and markets isn't always that strong.
Yeah.
But I'm not going to forecast the market. I can't forecast the economy, but that's my sense. Certainly is that the growth rate next year is going to be weaker. Okay. That's my sense.
Great. We just had a request from Peter if we can just roll back to the slide that had the checklist of the IML investment process. Yeah, just leave it on that one there for us. Hugh, or ladies and gentlemen, we're probably going to wrap it up in the next few minutes or so. So if you do have any questions you want to send through to Hugh, pop them in there. I will keep refreshing and keeping an eye out for those. Hugh, one of the things I did ask you to do was to bring along something that you're reading that you think is really enjoying. It's actually come up in the question. Someone saying, as people get ready for Christmas, do you want to talk us through something that's sort of blown your hair back? I know you brought a copy of it here for us.
I did bring a copy of that. I confess often I read sort of rather...
Tell people the name of it.
Junky fiction, and this is non-fiction, but it's absolutely compelling. It's called Sapiens, A Brief History of Humankind. I won't try and say the author's name, Yuval Noah Harari. He is a history professor at the Hebrew University of Jerusalem, I think. And anyway, his book is mind-blowing. It will, for a lot of people, really challenge their fundamental beliefs about how society is ordered and our justice system, our legal system, about religion. It's written in the most compelling, easy to read style. It's funny for a non-fiction book to be quite so compelling. I've really enjoyed it, and I kind of look forward to reading the next chapter. I'm halfway through now, and I feel as though I've been to university for a year reading 200 pages. It's anthropology and archaeology and history and the history of money. So there's a financial aspect to it. As a financial person, I can promote this.
Hold it up for people there.
The financial
Sapiens.
aspect is about the role money has played in human development. Can you think about what is money? Because historically it used to be things like beads or cowrie shells or gold. Now it's electronic entry. So what really is money? You think about it, it is trust. It's trust that money has value. And as long as everybody agrees money has value, it has value. Just as in the old days where people used cowrie shells in Africa, for example, to trade things, the reason you would accept cowrie shells for your bag of corn or something was that you knew you could take that cowrie shell to a market and buy what you wanted. Because that was an accepted means of exchange. Because the cowrie shell in and of itself has got no fundamental value, just as the entry in the bank account's got no fundamental value, but it does have fundamental value because when the plumber comes and fixes your leaking tap, he will accept a credit in his bank account from your bank account. There's no human service that you're providing an electronic thing. So there's no fundamental value, it's about trust. Yeah. And that has facilitated economic growth and interaction of large societies where we don't need barter. We can just rely on trust between people to trade, and trade has been very, very important to the development of large societies who get on. And you can meet a complete stranger, you don't need to know anything about them, they don't have to produce they produce something you want, you don't produce something they want. It doesn't matter, you don't have to match and say, I need a massage and you need a haircut. I can't give you a haircut, but I need a massage. You can say, I'll give you $100 for the massage, and then you can go and use that $100 and get a haircut from someone else. Yeah. Otherwise, you've got to exactly match in a barter system. Money has allowed great growth. Yeah. And it's underpinned the functioning of society. But that's only a part of the book. It's about how religion also has played a part in organizing society.
Don't do the spoiler. Let people read it.
It's fascinating, absolutely fascinating. But some people will find it very challenging. If you're devoutly religious, for example, you're going to say, oh my gosh, he's challenging all my beliefs and he can't be right. Well, anyway, make up your own mind.
All righty. had one more. We're about 5. We're going to finish up very shortly, but this one, it's a general sort of question, but I reckon it's a really fair question. In the current environment, sectors to avoid, sectors that look good. And I know these are broad brushstrokes, but you alluded to some tech stocks earlier with Afterpay and the likes and that sort of stuff. You've been around long enough. There must be, and screening for stocks, as you mentioned, in the large cap. Are there some areas that are looking over frothed and some other areas that look okay for you guys at the moment?
Well, it's easier to... there's stocks that have been very frothy, like WiseTech, Afterpay, seen as technology stocks. They've sold off a lot. They're probably still a little bit vulnerable because they're still on very high valuations. But I don't like picking on sectors. I look at stocks because they're different stocks within a sector. Like if you'd invested in primary healthcare several years ago, as far back as you want, you would have lost money. But if you'd invested in CSL or Cochlear, you would have multiplied your money several times. So sector alone's not a great thing to look at. One thing you can say, certain areas are very frothy, like in the US, and I think there might be a stock or two here that are onto the marijuana train. That looks like crazy frothiness. Anything that says, we're a blockchain or cryptocurrency thing, I think that's crazy. There's nothing fundamental underlying it. Sorry, everybody who loves Bitcoin and Ethereum, but I just cannot come to any fundamental value for those things. And people say, it's blockchain. I say, that's great technology, but the coin itself's not worth anything. So they're things which get very frothy. I much prefer solid companies that just are sort of a little bit more boring but grow earnings steadily, got that good management, good governance, those sort of things, rather than the thing that catch the eye because they seem to be exciting, have a good story.
Yeah, I think it probably sort of talks to one of the articles that Anton has written recently, which is about the value of dividends. And I know when he talks about the total return that you're looking to achieve for investors, that dividend is a really, you've got the capital growth component, which is the share price moving up, but he often talks about how important that dividend is. And if you're after a 10% return and you get 4% in your dividend, you only need the share price to go up 6% to get that return. So I think that's probably one of the common characteristics of stocks that you own would be earnings, cash, the ability to pay dividends.
Yes. Well, it's interesting, over our 20 years, we've got a table where we show the income has been quite reliable for our main fund at around 5% per annum. Half the return of 10% in the 20 years has come from income, from dividends, and the other half from capital growth. And the market over that time has returned about 8% per annum. We're happy to have beaten that a bit, but 5% has come from dividends. So it really does provide a great underpinning for your returns.
Well, Hugh, thanks very much for your commentary today.
Thanks, James.
Ladies and gentlemen, thank you very much for joining in on the webinar. As I said, this was our inaugural attempt in celebration of IML's 20-year anniversary. Up on the screen in front of you, you'll see a link through to the IML website. They're publishing a series of 20 lessons. I think they're up to about 7 or 8 from memory so far. More to come, videos and articles. I recommend you pop on over there and have a look at that site and access those insights directly from Investors Mutual. If you do have suggestions or feedback on the webinar, we're not perfect. We love doing these things and trying new ways to give you access to fund managers like Hugh and hopefully broaden your investment learnings and education. My name's James Marley. This is Hugh Giddy. Thank you once again for tuning in with us today. I hope you enjoyed the webinar.